Hello there. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I am Rose Marcello. I'm Senior Director Client Portfolio Manager at IGAM, and my guest today is Marc Gagnon, Vice President, Portfolio Manager, North American Equities. Marc is an award-winning portfolio manager with a long track record in Canadian equity, real estate income, and small cap strategies. Today, with Marc, we'll discuss geopolitics, catalysts for sustainable stock market rally, and positioning in his key equity mandates. Good morning, Marc, and welcome.
Hi, Rose. It's a pleasure for me to be with you today.
Thank you. So, Marc, you are a keen observer of geopolitical and macroeconomic issues. What is your assessment of current conditions in the market, and what will be the impact on the stock market over the next 6 to 12 months?
Oh, okay. So that's a very interesting question to start with. I think that's the most important. Where are we? And on the geopolitical front, we all know that, the last 4 years were not easy with the pandemic. That's created a very unusual situation. And that situation gave birth to, inflation because government, were facing the choice of having the economy stop completely, or on the other hand, they had to throw a lot of money at the economy to make sure that it wouldn't stop. And that's what inflation that came after that was actually a result of that, all that money being poured in the economy. Now the virus is still there, but we have learned to live with it. But we're still stuck with that inflation that went to a level, to such a level that we haven't seen in such a long time. We have to go back to the 80s to remember that kind of inflation. And there's a lot of people that in the investment community that haven't seen that kind of inflation. I remember it when I was young. I was not on the market at at that time, but still, I remember my parents paying 17% of their mortgage. So that's the kind of things that you remember in your life. But nevertheless, we are now stuck a bit about this kind of problem. And curiously enough, the market was not really believing that it would take that long to overcome the problem. I remember even at the beginning of this year in 2023, a lot of people on the market were expecting the Fed, for example, to cut their rates 3 times this year. And we know that in the past couple of years, rate went up very fast and very strongly. But the market was always like, we're about to see rate cuts, and things will get better. And for example, in the U.S. stock market, people were like, we're going to be able to see a soft landing. Rates are about to come down. And guess what? This hope came to an end not too long ago, actually at the end of September. On September the 20th, Powell gave a speech, and he made it clear that rates will be higher for longer. And I think that's where the market really took notice on the fact that it's not about to happen any day now. It's going to take a while before we see rates cut by the central banks around the world. And since then, we have seen, long rates taking 30 basis points in the U.S., the 10 years. We have seen also the stock market being much weaker. So for and it also we have seen in Europe, Mrs. Lagarde saying about the same thing for the ECB, mentioning that rates will remain higher for longer too. And we saw German 10-year bonds. It recently 2.8%, which is the highest level since 2011. So same thing for them. They're taking note that it's not gonna be like tomorrow that we're gonna see interest rate cuts from central bank. And I think it's very healthy to see For the first time in a while, both market and central bank expectation being set or reset at the same level, meaning that they're all gonna now see that rate cuts are not about to happen in the next month or two, and as I said, that's I think very healthy.
Good, Mark. So market have finally caught up with the rest of the world. Um, in your view, what would be the catalyst then for sustainable and diversified recovery of the stock market? And I say diversified, not like a tech specific recovery.
I think that the first thing we need to see, and this is really important. That's really at the basis of seeing our scenario unfolding and things getting better ultimately. And we see the trend in inflation continue to go down. We know that central banks they want to get back to a level of inflation that is close to 2%. Will it be two exactly or a little above? Maybe a little above could do the trick. Maybe 2.3, 2.2, even maybe 2.5, depending other things, taken in account. But still, so we have some way to do, but we don't have to get there before we see central banks starting to talk about easing a bit. So that's the first thing. Inflation needs to continue to trend down. The second thing that we're going to see if that happens, I think, is, and we're already starting to see it in Canada and in Europe, we will see economies entering recession. I think that on a per capita basis, for example, we're already there in Canada. Because the population growth is strong, we don't see it in the official numbers, but when you do the calculation on a per capita, we're already there. Same thing for Europe. Europe is more exposed to interest rate like Canada because of their mortgage structure, because also on the fact that companies in Europe rely more on loans instead of going with public markets to finance themselves. So when interest rate rise, it doesn't take long before companies, get it and have to, for example, reduce their labor force. So, but I think in the U.S. it might take a little longer because on the opposite, the some of their structural way of how the interest rates rise, circulate in the economy takes longer. For example, in the U.S. you can have a 30-year mortgage, so you're much less exposed to what's going on over the short term in terms of interest rise. Once again, also once you finance yourself with a bond, you issue a 10-year bonds, you're okay for 10 years. So there's much more like bonds issuance in the U.S. in terms of proportion of financing than in anywhere else in the world. So it's going to take a little longer. It's even might take, we even might see the Fed increasing rate one more time in November by 25 points. I think the odds right now are like 50-50 for another rate hike. But once we see also in the U.S. slowdown, and I think it will happen, like I said, in Europe, Canada, also China is in a tough spot economically. We're going to see long rates starting to stabilize. That will be the first step of seeing, things starting to improve. Because from there, I think with the economic slowdown, they will start to go down and we will see what we call an inversion of the curve where long rates 10 years for example will start to be much lower than short-term rates and we will see that it's going to be interesting in terms of investment. It will open up opportunity. And the next step after, and that will be the step that will, I think, really trigger a market, a better tone for the market, even the stock market, even a rally, I think, will be short-term rates, indication by central banks that their next move will be to lower short-term rates. So it's even not, seeing cuts. It's just central banks starting to talk about, you know what, maybe, things are slowing down enough. We see good things enough right now for inflation that we are starting to think about lowering rates. We're not there yet, but that's certainly something that we're taking off. And that will be, I think, the green light that the stock market will need, wherever you are, to see, a better performance and a more broad performance from equities.
So the real trigger will be the central banks announcing either rate cuts or that they're coming. So given this, what opportunities do you see I'd say, in a framework like this where you expect a recession? And how are you planning on positioning your various mandates?
Yeah, and maybe some people will be scared listening to that podcast. They will say, "Oh man, we're in a recession. I have to sell my positions right away." I would tell them, you know what? Don't forget one thing. Markets, especially stock markets, but markets in general, this is a game of anticipation. So right now, you might be, while you're listening to that, you might notice that the market has already been down. We're recording that podcast today, and market are down in average 1% in Canada and U.S. stock markets. So it's already happening in some sense that the market is come to their sense, the sense that we are, pretty close of a recession if we're not already in one. So the next move, and how we're staying invested right now, but how do we move the portfolio to capitalize on that? We're trying to move in more defensive stocks. And it happens that those stocks often also are the one that have the highest dividend, and I think it's going to pay, positively when people will start to see long rates stabilizing and even going down. That's where dividend stocks will even increase and not lose less, but be even in the posting positive returns because people will see it, interest rates on the 10 years bond going down, and they say, and I'm going to give an example. For example, BCE in Canada, the yield is above 7% right now. So they're going to see, 10-year bonds in Canada going down. They're going to say, oh, maybe BCE with the yield is quite interesting. It's overall, defensive business model. Okay, it's more risky than, of course, a government bond, but I'm being, compensated by that increased risk with a better spread between the dividend and the 10-year rate. So we think that dividend strategies and dividend stocks will start to outperform. That's going to be the first move. And as I said, when central banks around the world will start to hint about, our next move will be to cut interest rates, we think that the broad market will start to outperform, and even more the cyclical stocks will be where we're going to be. For those that follows my portfolios closely, they know that I've been, pretty strong on energy. That has paid handsomely so far this year. But right now, and actually at the beginning of August, we started to sell some energy stock. We're now slightly underweight, and we're even selling a little more these days. But when the central banks will hint at cutting rates, that's the kind of stocks that we're going to buy back. The cyclical one that will, have kind of an outperformance. And there will be also industrials, probably base metals. These are the kinds of position that we will buy then. So the game is a game of anticipation. We try to be ahead of the market. And while the market will move to dividend stock, we're slowly going to take profit and invest in more cyclical stocks. Of course, the key of that movement will be inflation, and we think, just to give dates, to give you a sense on when it can happen, we think that as soon as December Q1, it's going to be interesting for dividend strategy, Q1 of 2024. And by Q2, Q3 maximum, we'll see, a broader rally in the market next year. Of course, there's a lot of things that can move or postpone or even sometimes make it faster, that scenario. But overall, at this point, that's what I would hint in terms of timing. So, yeah, that's how we want to play the market at this point.
Well, thank you for sharing, Mark. That gives us a nice playbook, and we now understand even if you're expecting a slowdown or recession, you are not in cash, you are fully invested, and you have a very disciplined framework that you'll be following.
Yeah, that's exactly it. It's important because when a market rally, the first days are the one that pays the most. So it's really important to be there when it turn around, and that will come abruptly, and that's something that experience has taught me several times already.
Thank you so much, Marc, for being here today.
It was my pleasure.
Thanks. Bye bye.
Bye.